Hi, I am Rajshekar Kongari, Equity Research Analyst at William O'Neill, India. We have with us our Equity Research Head, Mahresh Joshi, and my colleague Rushit Sechpal as well in the meeting. I'll be starting the session. I'll be explaining few terms related to the budget, and I'll try to decode them to explain clearly to the layman terms. And my colleague Rushit will discuss about the sectoral impacts and what are the stocks which will impact on this budget. In between, our head Mahresh Joshi will also chip in and he will discuss more in depth. So first thing is, I hope everyone made good profits on their investments after budget. After budget, that is on February 1st, Nifty was up around 1%, and following day, that is yesterday as well, Nifty was seen following buying. Today's action is slightly, we can say, profit booking, also expiry related move because of expiry. We can say it is a more of a derivatives play rather than market, because today most of the weekly options have expired, so it's more of a open interest play between options and futures. We can consider today as a profit booking day, but overall I think the market has given a great signal to the budget. As you can see, broader markets have also advanced good.
Raj, sorry to interrupt you, but I think background voice is still coming. Can you just check about that?
Okay, I have closed my door as well. I hope it will be clear as the session progress. And I'll talk about the budget now. The budget was mainly focused on four priorities. That is, one is majorly on PM Gati Shakti, that is bringing synergy between existing infrastructure and logistics in the country. Finance Minister Nirmala Sitharaman has reiterated that but government is going to spend good capital is uh, looking at the long-term assets rather than the short-term bias. Even though there was an election in the upcoming elections in UP and other states, people were expecting it to be a populistic budget. And still, the government has made no changes in the tax structure, which will impact directly to the common people, you and me. But the government has talked about a long-term vision, that is spending more on capex rather than revenue expenditure. One more priority was inclusive development, that is more related to again to uh, bringing synergies between the existing infrastructure and the long-term vision. Third one was on the climate action, and here battery swapping methodology, which the government is planning to invest, that is to enhance electric vehicle movement in the country. The other one is the last one is the financing of investments. That is, government also has investments which are there in the private sector companies. So they're also trying to make more out of it by disinvestments and bringing those into the government capex. This is the major table which talks about total revenue, that is summation of both taxes and non-taxes revenue. Taxes, that is there is indirect tax and direct tax. Indirect tax, that is taxes paid by individual, that is income tax we pay to the government. In indirect tax, there is GST collections and other revenues like government get disinvestments from disinvesting public sector companies, and also RBI also gives dividends to the government every year. Those all comes under non-tax revenues. And total expenditure for the 2023 is estimated at 10.4 trillion, whereas total revenue was 22.8 trillion. And the difference between these two will be called as the fiscal deficit, that is 16.6, which is estimated as 6.4% of GDP. I was explaining that total expenditure was estimated at 39.4 trillion for the 2023. On revenue front, it is estimated at 22.8 trillion rupees. The difference between these two is 16.6, that is fiscal deficit, where government goes to borrowings like giving bonds issuance to match the expenditure. So it is estimated at 6.4% of the nominal GDP. For the current year, that is FY22, it is revised at 6.9% from 6.2%, which is budgeted estimate of current year. And the trend in tax receipts, that is both direct tax and indirect tax, you can see it has been projected at 10.7 for 2023 from 10.8%. There is no major change announcement in the tax structure. So I think the government has also given a reasonable number at around 10.7%. That is 5.5% of direct tax and 5.2% of indirect tax. And we'll try to understand the receipts and how the government makes money. One is capital receipts and the other one is revenue receipts. As I mentioned previously, it is estimated at 37.9 trillion for the FY23 budgeted estimate. Within the capital receipts, there is a major chunk is from the borrowings. That is, government will issue bonds to the companies and to the investors. That is estimated at 15 trillion. And other 800 billion is from recovery of loans and other receipts, which are estimated at 650 billion. Within the revenue receipts, which is 22 trillion estimated, net tax revenue is estimated at 19.3 trillion and non-tax revenue is 2.7 trillion. Here, non-tax revenue talks about dividends from the public sector companies and like RBI and other BHL, all the sectors, all the companies which give dividends to the government. Net tax revenue is a net amount which central government receives after paying the share of state governments. Here, both the GST and income tax comes. And talking about deficit trends, there are actually two major deficits, that is fiscal deficit and revenue deficit. Fiscal deficit, I have already talked in the previous slide. That is difference of total expenditure and total revenue, which is estimated at 16.6 trillion. That is 6.4% of GDP, lower from 6.9 from the last year. That is current year. And revenue deficit is a difference between revenue expenditure and revenue receipts. Here we are estimated revenue receipts at 22 trillion. I'll talk expenditure in coming slides. That difference between revenue receipts and revenue expenditure is called as revenue deficit. And all the deficit numbers are always benchmarked with the GDP. That is, they are always talked about in terms of percentage of GDP. But talking about borrowings, that is, government has a deficit currently because the expenditure is on the higher side, revenue is on the lower side. So government has to borrow to match those numbers. So to do that, it does mostly bond issuances. That is, government bonds issued to the public and the companies. Other ways of making money is financing small saving schemes. Here, that is uh, people, that is investors, have saving schemes invested with the government. Government uses that fund to take a loan on that particular fund. And one more way of borrowing is T-bills, that is short-term borrowings, 30-day, 90-day bills, which are issued by the RBI. Coming to the expenditure part, for FY23, that is the coming financial year, it is estimated at 39.45 trillion. That is a growth of 4.6% compared to the revised estimate of FY22. Within the total expenditure, we have two parts, that is revenue expenditure and capital expenditure. Revenue expenditure is that meeting day-to-day goals of the government, that is subsidies or the interest payments. It's like if you are in a household, we have to pay the rent and electricity bill, that is considered as a revenue expenditure, whereas capital expenditure is like within the savings you try to invest those money with the stocks, or you buy a real estate asset, that is for the long term vision. Same thing, government also does the same thing, that is that capital expenditure is spent on building roads, railways and airports, which will have a multiplier effect on the economy. I hope I have explained what is revenue expenditure and capital expenditure. So the major point the government has emphasized is the increase in expenditure, capital expenditure, at this current in this current budget. Even though it was a populist, people were expecting a populist budget because of elections, the government has given a long-term vision budget by increasing the capex rather than the revenue expenditure. That is, the government wants to invest in the infrastructure to bring back the economy on growing phase after this pandemic. Capex, it is estimated 7.5 trillion. That is an increase of 35% compared to the previous year. Whereas overall expenditure was up only 4.6%. Within that, major chunk increase was made in the capex. As you can see, 35% increase was there in the capex, because of investments in the roads and other missions where we have long-term fruits rather than the timely fruits. And how does the government make money? I have already talked about it, but for each rupee of government money, 15% is from the income tax that employees pay to the government. That is a major chunk. And GST as well is around 16%. That is the taxes we pay on the goods and services. Borrowings form a 35% of the total money the government makes, and other revenues like customs duty, corporation tax, non-debt capital receipts form the other chunk of the money. And talking about the expenditure, major chunk is gone to the interest payments, that is 20%, because of the borrowings the government has. Government has to pay the interest to the borrowings. 20% goes into that. Share of states taxes is around 17%, and central sector schemes like Manrega, PM Kisan, PM Awas Yojana, that will take around 15% of the expenditure. And other major were pensions, subsidies, and defense investments. This is the slide where we talk about spending of government on major central schemes. You can see here important point here, Manrega, which people don't like, has decreased 25% in the current estimate, which is a good sign. Whereas the other Jal Jeevan Mission, National Education Mission, Health Mission have seen a good improvement in the budget allocations. Only the Manrega has seen dip in the allocation. And disinvestment, that is disinvesting government holdings in the public sector companies. For the current year, FY22, it has lowered 55% because government was not able to make disinvestments because of pandemic and the not so good market behavior. For the 2023, it is estimated at 65,000 crores that government will make from disinvesting. The major will be from the BPCL disinvestment the government is planning. It would at least mop up around 45,000 crores there. And other companies government is planning are Concur, BML, IDBI Bank, SCI. In current year, LIC IPO will also come, where government will also make good money by offering their share.
Yeah. So thanks, Rajshekar. So Rushit, I think just give a few of my takes on the budget, and then we'll have a detailed discussion on the sector implications that we have obviously drawn out. So first of all, can you guys hear me loud and clear?
Yes, sir. By the show. I can hear.
Sure. Secondly, I think we will carry out with the sector implications, and therefore I think big kudos to the entire team, Rajshekar, Rushit, Vakar, Yash, Yatisha as well. I think they have absolutely decoded the budget in the right form, right till the budget day, I think 3 days before that. And immediately, I think the whole team was sitting up the whole night. We were working through the whole day yesterday so that we could come out with the report today and help analyze and interpret the budget in our own sense. Now, coming to the interpretation of the budget itself, as Rajshekar has wonderfully explained, my own sense is that the entire budget over the last few years has purely, squarely laid its thesis and the entire background in terms of capex oriented growth. Secondly, I think the capex that the government is trying to put forth is with the intention that all this will ultimately start playing out in terms of private capex, which will start coming through. Therefore, as the government has been spending tons of money into the capital account, as Rajshekar mentioned, and this year as well, the allocation has been substantially higher. So almost a 24.5% increase over the revised estimates that the Exchequer has put forth at 7.5 lakh crores. Second, I think with all these expenditure coming through, the hope now is that private expenditure will start coming through. And as private expenditure or private capex, as we call it, starts coming through in a very meaningful fashion, the entire 3 or 4 circles in terms of how an economy moves, manufacturing, consumption, and the service-oriented industry, I think all these elements start moving in the right direction. Yes, did the budget come short in terms of creating demand or demand incentives? Absolutely, yes. There is no two ways about it. I am not shying away from it. But the intention again of the government is on the 4 pillars that they have discussed to have this capex put forth so that the private capex comes through and demand automatically gets created as more and more employment comes through. As more employment comes through, there will be more wages that probably get spread out evenly into the system, taking care of wage inflation and cost push inflation that will not seep into the system over the next few quarters. And hopefully with more and more wages coming through and more jobs getting created, the consumption cycle comes through, and therefore I think whatever gets manufactured gets consumed at a faster scale, creating a huge cyclical uptick in terms of the GDP growth as well. But yes, no direct measures in terms of demand. And as Rajshekar also put forth, I think the other thing which probably just disappointed me a tad bit also was the reduction in allocations towards Manrega. Now, rural spending in the past budgets have been around 11.5 to 12% in terms of the overall GDP. And they've come down in the last 2 years because of COVID waves from 13.5%. So that 1% of the GDP allocation towards rural that gets cut off. And with Manrega probably getting cut off even more, I think the whole purpose in terms of giving sustainable employment and therefore carrying that consumption cycle specifically in rural areas and semi-urban areas I think let's see how that probably happens and whether government has some supplementary grants that it did like last year, because the allocation last year in the budget estimates were 73 odd thousand crores. They had an additional allocation of 25, which carried this figure to 98 odd thousand crores in revised estimates as far as allocation for Manrega is concerned, and we're back to 70 odd thousand at this point of time. So over a period of the next few months, what probably happens in terms of further allocations here, maybe that can give some respite to the rural economy as well. The second element in terms of the GDP estimates that the government has done, 8.5. Let's assume the higher end of the range at 8.5. And the tax collections, as Rajshekhar mentioned, I think the assumptions for tax collections are 10% this year on a gross level. The nominal GDP is expected at 11.1%. So for the first time, I think we're trying to factor in the tax revenue. I think the next tax revenue receipt, I'm not talking about the capital receipts that the government gets, which is RBI dividend, so on and so forth. The next tax receipts are expected to grow lower than nominal GDP. So I think what the government is trying to probably presume is lower fuel taxes, because we had a huge amount of contribution in excise from higher fuel taxes this year. And again, I think the credibility in terms of keeping the divestment figure to 65,000 looks reasonable at this point of time. The second element, obviously, is the borrowing target that the government has taken on its chin to fund the higher amount of expenditure that they're probably expected to carry forth. And with the lower assumption of tax growth being lower than nominal GDP, as I just mentioned, the net borrowing that has been set at 1120, 1130, 11,30,000 odd crores. So that can have implications, because they are probably assuming that if imported inflation hits us, if global demand goes into a slowdown, if there is a cyclicality that gets involved because of lesser global trade, exports, which are probably expecting to hit 400 billion odd this fiscal year, if it does not expand in a larger sense the next financial year as well. I think all these elements the government is trying to play safe, trying to be conservative because of the outside macro risks and the geopolitical risks as well. And therefore, I think the entire capex agenda that has probably happened is entirely based in the assumption that execution both on government projects and private capex will happen at a absolutely strong level. Saurabh, that you pointed out in terms of the question, PLI allocation, how much has it increased? The PLI allocation in terms of the announcements in the budget for solar, for renewables, for solar modular panels of 19 odd thousand crores, I think step in the right direction, because what has been happening is we are importing a lot of this stuff from China and other Southeast Asian economies as well. What the PLI that has got announced even before the budget, because a lot of these PLIs have got announced outside the budget as well. For textiles, as an example, the road step which they have got through, and I did mention in one of my earlier in our earlier webinars as well, the earlier law that was before road step, right? ROSCCP, if I'm not mistaken, electronics a few years back, or exactly a decade ago, had a huge amount of export incentives that were put forth. Now, electronics as a percentage of GDP in terms of exports were very, very minuscule at that point of time. Over the next few quarters, because of the PLI, the backward integration, the sourcing that was made available, you actually had a quantum jump in terms of electronics and hard machinery that got exported. And therefore, I think the entire logic that got put forth in terms of the expectations laid out on PLI schemes is a thing in the right direction. It serves three broad purposes and perspectives that the government has. Employment generation, because as more and more funds become available, and as more private sector entities start utilizing these funds and expanding their capacities, employment can come through. Second, the integration that they need to carry on and have lesser amount of sourcing requirements from nations outside India. So I think it also eases the pressure in terms of our foreign exchange. At the same time, it eases the burden on the companies itself in terms of volatility of both foreign exchange as well as raw material prices. And third, I think it gives an equal opportunity for those companies in that respective sector to be very, very competitive because of the first two factors, to compete with other nations. So, for example, in textiles, we compete with Bangladesh and Pakistan, as an example. When you're talking about solar PV modules, China, other Southeast Asian economies become a huge competitor to us. When you're talking about semiconductors, Taiwan has one of the largest factories in terms of semiconductor and chip manufacturing as well. So I think there is sufficient amount of elements that are probably getting put forth in terms of all these parks that can come through. We're already talking about textile park. We're probably expecting to see more manufacturing hubs come through. And what the finance minister had announced a couple of budgets ago in terms of new manufacturing capacity is actually getting taxed at 15%. I think it's a very, very welcome move, because as fresh capex gets put in, you've got tax holidays in certain states. On the other hand, you've also got in certain areas which you are not able to or eligible to perform out of tax holidays, tax at 15%, which is significantly lower. The third element in terms of all these PLI schemes is also the element in terms of EV, right? Because I think the next few years, the transition factor that is going to happen is electric vehicles and renewable energy. I think all global major economies are talking on these grounds as well to probably reduce carbon emissions, carbon transmissions as well, and therefore green energy, green hydrogen is everything that is probably going to come into account as well. So I think anything related to this is obviously going to have multitude benefits, and therefore I think that will always play as a multiplier effect on certain sectors and stocks going forward. Gurinder had a question that budget gives capital allocation and decides which sectors are likely to benefit. The budget present is absolutely essential. Absolutely yes, because what probably happens is you actually get a clue in terms of what the government is trying to put forth. So budget is a document again which is presenting the state of our nation's. It's basically our nation's balance sheet, right? How much is the country earning through taxes? How much is the country spending in terms of capital schemes, on social schemes, and on subsidy generation as well? And this gives us a perspective in terms of the government thinking. Last few years, your entire purpose for the first 15 minutes was the government thinking is very, very clear in terms of capital allocation, creating resources, and spending on capital accounts. So revenue spending, somebody asked the question as well, can be fruitful or it can be wasteful as well. So revenue spending can be something in terms of spending of purposes other than creating national assets, which as utilized and churned can create huge amount of revenues for the exchequer as well as private capex stepping in to ensure that our GDP grows at a reasonable amount of pace. Revenue expenditure does not really translate into GDP growth for the economy and can be quite wasteful if not used in the right direction. And a lot of revenue expenditure, as I have seen in the past, goes in form of either subsidies or it goes in the form of wasteful expenditure, which does not churn back into the economy and help generate a larger amount of GDP. With that, I think my entire thesis or what the team has put forth in terms through the reports is that the budget, the intent is in the right direction. Does it lack on a few things like creation of demand? Yes. Does it lack in a few things like allocation for a few schemes? Yes. Can the government rectify, go behind that and have more budgetary allocation through supplementary grants by allocating more in the next few months if it finds that the economy probably is not going in the right direction? Quite possible. And third, I think the estimates or the conservative approach that the government has taken is largely based in terms of global cues and global macro factors, which can actually turn out to be worse. So I think the government is trying to prepare itself for the worst and assume conservative figures, which I think is very, very in the right direction and it is very, very credible as far as all these aspects are concerned. We've carried our detailed note on sector implication. However, I think we will still go through the presentation in terms of what we feel the announcements for the budget were for certain sectors, stocks of interest which can react, assuming budget announcements which we have carried in the report. And therefore, Rushit will take forward, and me, Rushit Rajshekar, will keep on giving our inputs throughout what we are going forward. So thanks, guys. Rushit, you can take forward.
Thanks, Mayuresh. So yes, as Mayuresh and Rajshekar discussed, it's a pro-growth budget with capex at epicenter. And so firstly, we start with let's make in India. So first thing is about the defense. So this is not a new theme, make in India and defense. So it has been seen that since the 2014, after Modi government came, their focus is more on make in India, especially the defense. Like they also want to do the export of defense. And some plants, take a time. Like some of the best trees, best fruits takes a time to get reaped. Say, for example, mango, it takes years. So, but the progress should be there. So this is what is visible over here. The progress is there. So the government has committed to reduce the defense imports under the Atmanirbhar Bharat. and they have increased procurement from domestic companies to 68% from 58%. So this is what you need to see, that how the progress is going. So this is something like now we are increasing more and more domestic consumption from the defense sector, right? And our plan is ultimately to be very much produce in India and also export. So we have also got some of the export orders, right, from for the defense sector, and this is where you can see the progress is. So what happens, like Indian defense companies, they will get a lot of order, BEL, BHEL, right, Bharat Forge, L&T. So these all companies, and yeah, a disclaimer that the stocks or the sectors that I discuss over now is not a recommendation to buy or sell. It is just, the positive, the negative impact, or the implications through the budget that has been coming, right? So please make that clear as a disclaimer. So I was talking about these stocks, right? BEL, BHEL, L&T, they will benefit from the defense, right? Then there are other stocks as well, like say, which will be benefiting from this defense, and the entire chain will be created. It is not about only the one company that, okay, this company manufactures the this defense equipment, but the entire chain will be benefited, some small part manufacturers and all those things. So that is why the focus is more on the expenditure, right? If you go through a infrastructure, so let's go ahead. Okay, so I will discuss that on the later slides. So the second one is the telecom, right? So this has been one of a big sector in India. So 10 years back, right, there was no much technology, no many mobile phones, right? Our service sector was in the growing stage, but now you can see there is a lot of consumption in the mobile. And India, in fact, the per person consumption of internet is highest in India, right? That has been in the few of the surveys it has been coming. So that is where the telecom sector is booming. If you can see the internet consumption, Jio, Airtel, the Vodafone, the number of subscribers have substantially increased if you compare it with the last 5 years. इतने तो अभी शेयर मार्केट में भी लोग नहीं बढ़े हैं जितने पिछले 2-3 साल में रेट था telecom subscribers बढ़ने का, right? So these companies have already been very good in technology, but now the government wants to focus on the next technology. So first we used to always say that, okay, India is lagging behind in this technology. We are 20 years behind, we are 25 years behind, and there used to be a debate कि हम कितने साल पीछे हैं दुनिया से, right? But this government since last few years have not allowed to do that, right? So we are not much behind. So now we are coming up with the 5G technology, right? And there is a spectrum auction expected in 2022, and government is focusing of around 230 billion of upfront received from the auction, right? The telecom sector in general and 5G technologies particular can enable a lot of growth opportunity for country along with a job creation. So इससे क्या होता है कि not only in the white collar jobs, but say for example the government wants to roll out 5G, right? And they want to give contract for the optical fiber in village. So a lot of digging work needs to be done. A lot of small workers get employed. And there was some discussion कि populist budget नहीं है, मनरेगा में पैसा कम दिया है. There were expectation that the money will be given higher in मनरेगा, the number of days will be increased, right? And in our pre-budget or note also, we had mentioned that these were the expectations from the analysts that, okay, the मनरेगा will increase. But what government has done, government has given have a plan to give a proper job. It's not like just मनरेगा that, okay, you come here, do the work which is not that fruitful, and you get your 150 rupees, right? But now the government focuses on that, the infrastructure, right? So building roads, building highways, laying this optical fiber network in the village area. So that will generate employment from the ground level. Yes, it might take some time, to reflect, but it is not like Manrega that only today itself, the things can start. This might take some time, the tendering, the progress of the work, but this is very good for the economy. This is the structural change that we are talking about. And see, you need to understand, see, one is the credit cycle, right? And second is the capex cycle. So India is almost done with their credit cycle, and now we are moving towards the capex cycle. And the government is leading from. The government is the torch barrier of this capex cycle. And as Mayuresh also discussed, so a lot of investment from the private sector is also expected. उन लोगों का भी capex बहुत बढ़ेगा. The main theme was the infrastructure, right? So the national highway network has to be expanded by almost around 25,000 kilometers, right? So if around 25,000 kilometers of roads or highway needs to be laid down, right? So this will give a lot many orders to the our firms that are building the highways, and not only that, that will improve the demand of the cement, right? Not only cement, but to build a highway, you need a lot of equipments, right? To build a road, to build a railway, so some of the water plants, to build the connect the rivers. So a lot of machinery is also needed. So that is where the manufacturing sector comes in. Okay, so they produce the machinery, the cement guys will supply the cement, the execution companies, for example, the KNR, the other companies, L&T will build the highway. So the entire chain again gets developed and all gets a good share, right? Then also some 4 multimodal national park will be awarded in FY23. And yes, the PM Gati Shakti 100 terminals will be set up in the next 3 years, right? The other thing is the government has provided an infrastructure status to data centers. So this has been a very positive move. So not only the traditional sector the government is focused on, but the government has an equal eye on the upcoming sector. Like they are focused on the data center, they are focused on the renewable energy, electric vehicles, right? So all the things were very well covered in the budget. So I think a couple of data related companies are also listed, and these also might get a lot of benefit. And now if you come to the PM Awas Yojana, around 48,000 crore has been allocated for housing in FY23 and aims to complete around 80 lakh houses for both rural and urban region. So over here again, the building materials, right, the home improvements, the tiles companies, someone like the Kajaria or the piping companies, all of these will get a lot of benefit. Okay, so this has been increased. That is the Jal Jeevan Mission. So for 2021, there was around 45,000 crores spent over here. But now as the pandemic is almost, the economy has become normal. So government is again more focused to provide water in every tap in the country, right? So around 60,000 crore of allocation is given for FY23. So this will the plastic pipe industry, the piping industry will be the direct beneficiary of Jal Jeevan Mission. So this is how all the stakeholder in the infrastructure chain, in the economic chain is getting their share, right? So to develop or the work for this Jal Jeevan Mission, it is not automated, right? There needs to be given a lot of employment if you want to carry out such a huge infrastructural work, right? And so that's what we were talking about. Okay, so next, that's about the electric vehicle and clean energy. So Mayuresh gave us some brief about this. And see, one thing which you should also understand that it's not only about, providing money to this sector or this sectors get developed. If you look at very broadly, from where in what sector the investment is coming. So nowadays, if you look outside the India, let's say, for example, Europe, USA, or you can say the very huge Japanese pension fund. So where they want to invest. So they want to invest in clean energy, green energy, right? So you might have heard, most of you might be aware about the ESG indexes, right? The sustainable index, the sustainability rating, right? So these investment themes are very famous. So let's say, for example, some of you guys might be thinking that, okay, our focus is not now on the clean or the green energy, but we should focus on our GDP growth. The US is already the developed one. The China is having such a huge GDP, but we want to reach 5, 6, 7 trillion in the future. But we need investments, right, guys? We need the FDIs investing. We need the FIIs investing in the market. अभी 2-4 हजार करोड़ का माल बेचता है तो हेडलाइन बना देते हैं कि एफआई माल बेच के गया। तो हमको चाहिए, वी वांट एफआईआईज टू बी invested over here, we want new money flow. So where this will come? So there is a theme going on in the market, that is the ESG index are there, the the ESG ratings, what are the sustainable rating of the country, what are the sustainable rating of the company. So if the government is investing more and more, say for example these green bonds, so they will have a lot of takers, the green bonds, right? And if the government is leading this clean energy thing, then the companies will also follow and they will also get a very good investment. So from investment point of view also, just don't look this as कि हाँ bond निकाल दिया या 19,500 करोड़ PLI के लिए दे दिया तो ये 4 कंपनी का भाव 5% बढ़ जाएगा. It is not just limited to that. It is in a very broader aspect. The entire theme is playing the ESG. Just after the webinar, you just Google ESG ETF, the value of the ESG ETF in the market, or how ESG investing is the new theme, and that is how you will understand the importance of the electric vehicle or the clean energy and more investment over there, right? The third point, which is very important over here, is the battery swapping policy to allow EV charging station for automobiles will be framed. So what is happening now? So this charging is taking a lot of time, right? And so with battery swapping, the EV will become more feasible to use. And I think so this is a very right step. So this will allow a lot of players to get benefit. So ultimately the quick beneficiary will be the battery makers, right? And then some of the chemical companies which provide some raw materials to, to the battery makers, and ultimately the EV car manufacturers or the bike manufacturers, they will also get a benefit out of this, because this will make usage of electric vehicles very easy in the country, right? So this is how a very pragmatic budget this was. So you might think that there are no major surprises, deduction nahi bada, income tax mein kuch change nahi hua. But if you look at the way the expenditure is planned, that is really good. Okay, so now if you come to the BFSI sector, which is very huge in India, yes, so the ECGLS scheme is extended, right, for one more year, and they have increased the limit to 5 trillion from 4.5 trillion. तो अभी इससे सबसे बड़ा बेनिफिशियरी होगा MSME sector, right? So MSME sector will be having a very good benefit. But if you look at the banking sector, if there is some analysis that in 2021 ECLGS accounts for around 20% of loan growth, right? So this scheme has aided the loan growth. So not only the person who is taking the loan, but the banking industry is getting a benefit out of this, right? And it is expected that with this expansion, the companies will also get a lot of advantage. But bank के लिए one problem is that the borrowings is increasing, so there might be some issue with the yields, and that might have some a brief negative impact on the bank. But yeah, with this all growth, and especially what Mayuresh was talking about, the private capex. So one thing is government capex, which they are doing, right? They have a plans to do, but the private capex, you look at the statements of the Ambanis, the Birlas, Tatas, Adanis, everyone is now going for the capex. If you look at any industrialist, just read the transcript or just read just look at the interviews on YouTube or Google about the any big heads in India. So they are talking about spending. They want to spend. And what do we think? Like we were discussing with Mayuresh, that not only the government spending, but the private spending might even exceed that, right, in the future. And that is how from both the ends, the country will get a very good boost, and we will be able to achieve a very high GDP in the coming years, right? So this is the benefit. So bank will be benefiting with the private capex. अगर private capex करना है तो simple logic वही है ना, वो पैसा तो वो बैंक से ही उठेगा ना. Some big houses will take the loans from the banks, right? And and they will pay, right? If Tatas are taking the money from the bank, if Birlas are taking, it's a sure shot. It's something like a treasury, right? That you are giving into. So that is how the banking sector will also be very benefited with the capex. Now, government has this time not allocated anything for recapitalization. Firstly, it was always a trend that whenever the budget comes, the agriculture में fertilizer को ज़्यादा पैसा मिलेगा, PSU बैंक का recapitalization होगा. So everyone used to focus on the fertilizer stocks, the PSU banks. But that was a very traditional, some populist kind of thing. But now government has stopped that. We will also see that the fertilizer में भी subsidy कम किया. And if you look at the PSU banks also, so now they are quite well placed, right? So no allocation for recapitalization. And also for FY 2022, the budgeted estimate was 200 billion, but the revised estimate is now only 150 billion. And I think couple of banks, they are also trying to privatize, right? Today only the DPAM secretary had some comment about, or some Bloomberg references were there. I'm not sure that about the IDBI stake sales by the LIC and all those things. So the things are progressing really well as far as the disinvestment is concerned around the bankings. Now, this was new, that introduction of digital currency, that is the digital rupee by RBI in FY23. So crypto pe tax laga diya, 30% tax on the crypto. So anyways, if you look at last 1-2 years, right, there is no much earnings in the crypto broadly, but yes, the government has put almost 30% tax on the crypto, and I think this will, help people be a bit away from these, there is no asset backing as far as the cryptos are concerned, right? So it's better to avoid something that you don't understand. And the introduction of digital currency, digital rupee. So this is a very good step to, as the world is digitalizing, and these kind of currencies are the need of the hour. Government doesn't want to be behind that, so they have asked RBI to introduce the digital rupee. So let's see and study that how these digital rupee will be, and what all help this will do. Okay, now coming to oil and gas. Again, that's what the theme is. Subsidy को cut करना, right? And capex बढ़ाना, ताकि everyone gets a huge opportunity to grow. So LPG subsidy for FY22 has been reduced from the budgeted estimate of 125 billion to just 34 billion, right? And for FY23, the budget estimate is only 40 billion, and I think that is also the DBT, that is the direct benefit transfer के लिए ही है these things, right? So the government has cut the subsidy over here, and the focus on the blended fuel, right? So this has been a theme for last 1 year. The sugar stocks are doing really well, right? The ethanol blending and all. So government is very committed to do this, and they have a very strict timeline to do that. And these things, give more confidence on their plans, that the unblended fuel will attract additional excise duty of rupees 2 per liter from October 2022. So this will, force the companies to be on the time to blend the fuels, the ethanol in the fuel, 5, 10, 15%. According to the targets, right? And so this will increase the demand of ethanol. And you can say a sustainable demand more than the demand, right? Because demand is already there, but it will be a sustainable demand. And the government is very clear about the policy. This is one thing that this budget has told, that the government is very clear on their policy, and the plans they have set in last few years, they are continuing them. So this is how this budget has been read. So the textile sector is, booming with China +1, and a lot of demand from the US and Europe for the Indian textile industry, and our textile industry, as we have discussed a few times, having a entire chain, right? Entire manufacturing chain. So the problem was about the cotton. The cotton prices were very high, and so the government has reduced the custom duty on cotton yarn from to 10% from 20%, right? So this will benefit the textile industry a lot. Yeah, few of the cotton players might have, but the demand is such that they might not be having a major impact. Now we come to consumer staples. So yes, we have discussed about this Manrega. So the allocation has been reduced, right, to 730 billion in 23 budget estimates from 980 in 2022 revised estimates. So in first view, this indicates that we already struggling rural economy, or the jobs are less in the rural India, and the Manrega has also been reduced. But you should look at it as two way. First thing that I have already discussed, that the capex will generate a lot of jobs in the rural areas as well, because a lot of capex will be focused on the rural area, right? Right from the internet, the piping, right? You don't need pipings in Mumbai or Delhi, right? You need the more of the piping in the rural area. So the employment generation will be there. The second thing, this is the allocation. So if something comes up, right, and more needs to be given to the Manrega, then it is not that 730 is the threshold. So, but the focus of the government is very clear, that they want to create a proper job and not give away like this. So that has been a look positive by the market. Now, the next thing, which this is again, everyone looks in every budget since last many years. I've been watching that tobacco पे कितना टैक्स बढ़ा हुआ है, सिगरेट कितना महंगा होगा. So that is what. But this time no tax has been increased. So 55% was the tax, and it remained, right. So there were expectations, and people were talking that the international standard is somewhere around 75%, and so government will try to meet that standard and increase the tax to maybe 60, 65, or maybe directly 75. But that has not happened. So last year also this was untouched, and this time also there was no change in the tobacco taxation. And I think ITC was on the screens of a lot of news channels when this announcement was understood in the budget note, that there was no tax on the tobacco, right? So the other thing for the consumer staple is, so this is very related to the company specific. This is not related to demand, right? That there is a withdrawal of concessional tax of 15% on dividend income received by the Indian companies from foreign company, जो उनका foreign में subsidy होता है, or holding companies, from there the dividend, there was a concessional tax rate of 15%, but it is not now. So the dividend tax can increase for someone like Dabur, Marico, Pidilite, Tata Consumer from their export units, or maybe the subsidiary over there. The last one, again, the fertilizer. We have discussed it, that the government has reduced the fertilizer subsidy for FY23 revised estimate to 1.05 trillion. Okay. From 1.4 trillion in 22 budget estimates. The last one, we see this is the chemical, right? So there was some duty changes, that the duties was reduced on methanol from 2 to 2.5% from 5% earlier, and acetic acid mein to 5% from 7.5% earlier. So this would benefit the downstream players of acetic acid. So it has been analyzed that this can benefit Lakshmi Organic, Jubilant Ingravia, and Roshari Biotech in a small way. And it might be a little negative for some of the methanol manufacturers like GSFC and Deepak Fertilizer. But as I told you, the government gives a lot of things in mind, and this can be easily offset the way the demand is. So there won't be a major impact on GFFC or the Deepak Fertilizer. So generally, you will always observe that whenever this duties are increased, decreased, it's all about the local demand supply. अगर local player के पास माल इतना पड़ा है, तो government इतना easily export नहीं होने देती है. So this is a basic logic. So whenever such thing happens, don't take it that this will be a huge negative. right? Because it will impact for sure, but it might not impact with that much intensity, right? Okay, so this was all about the sectorial front, and now I invite Mayuresh to give his comments about the sector index or maybe the.
No, absolutely. So, Rushad, I think very nicely explained. So, thank you so much for that. So, folks, I think the intention here was to break down the announcements in the budget, how different sectors might get impacted by it. So, there is a direct and an indirect connotation in terms of what the budget announcements are for certain sectors and certain stocks within those sectors. So, what we've tried to do is we've tried to comprehensively cover most areas or almost all areas of the budget, which impact sectors and few of the stocks which might get positively or negatively impacted because of the same. Now I'll go question wise in some of the questions in the chat. Now Manish had asked a question that if capex is so Manish, let me pull that question out. The government has announced concessional abolishment on imported capital goods to promote local capital goods. Will it impact other sectors? Isn't the project capex cost on higher procurement costs from local sourcing? No, so there are two things, Manish, here. I think what the government is trying to intend in terms of local sourcing or private capex. Now, when does a private capex kick in, right? Once certain threshold or capacity utilization levels are reached. I'll give you an example of cement companies as an example, right? So cement companies are operating at an capacity utilization, which means that if you take their plants and the utilization is around 65-70%, so they are utilizing their plant at 70%. यानी अगर 100 रुपये का माल बन सकता था सीमेंट के प्लांट से, डिमांड हो, सप्लाई हो, कोई भी डायनेमिक्स हो, 70 रुपये का माल बन रहा है. Now in a typical capex at 70 rupees, no corporate will try to expand its capacities. Now they will ideally look at the capacity utilization, which means कि अगर मेरा माल 80 रुपए का बिक रहा है ये प्लांट से, which means I'm producing stuff worth 100 rupees at full utilization, यानी पूरा प्लांट का जितना कैपेसिटी है और पूरा कैपेसिटी पे मैं अगर 80 रुपए का माल बेच रहा हूँ, तो मुझे लग रहा है कि डिमांड जोरदार वापस आ रही है, डिमांड इज कमिंग टू कम बैक रोरिंग. And therefore, once it starts hitting that threshold of 80 or 85%, companies, and there is a consistency observed, right, for a quarter or two, companies will go for a fresh round of capex. Now, what government capex does is the government spurs investment into sectors, and therefore, once that entire demand generation starts coming through, private companies का utilization level जैसे बढ़ते जाता है, as I mentioned in the example of cement companies at 80-85, they will start putting additional cement plants because it's not an overnight process, right? To put a plant, whether it's a clinker or a grinding unit, a brownfield, which means existing plant पे थोड़ा modifications करके expansion करना capacity, or greenfield, which means an absolute new plant to come into place. Along with captive power, which is very, very essential, as Rushit also mentioned in terms of ESG investing, which has become a very, very critical source for foreign institutional investors and domestic investors as well. तो जब एक capex की होती है, एक दो साल बाद वो plant आएगा, and therefore I think the whole vicious cycle that the government has started over the last 2-3 years, as this demand starts coming through, cement companies on an average are around 70%. As that hits 80%, because as Rushid also put forth in his sectoral implications, 48,000 crores allocated for Awas Yojana. There is this rural development also, where allocation has increased from 14,000 crores to 19,000 crores. What you're seeing in terms of port development, you're also seeing all these interlinking of rivers and all that stuff. That work seriously will start in a very serious fashion. And if all that starts happening, the requirement in terms of cement, other materials required along with that, right? All these elements will be required. And as those capacities start hitting in, more and more capacities will start coming. And therefore, the question of local sourcing and whether it's inflation in nature, I think that probably does not work out. It's a very cohesive part where I think the costs are balanced, the pass-throughs are balanced very, very nicely without causing an inflationary effect on end products because of the balance of demand supply. Because ultimately economics mein balance hota hai demand supply ka. How much of supply is there to match demand? The problem in the world today is that because of supply constraints, most factories in Southeast Asia, most factories in Europe, most factories which are producing and manufacturing goods are either stuck or shut because of COVID, lack of staff, and therefore the entire chain that you're seeing, mal itna ban nahi raha hai, stuff is not being made. You're obviously seeing congestion at ports. You're seeing high freight rates come through, and that pass through is happening in terms of prices, and demand has come roaring back. So supply itna hi aa raha hai, demand itna aa raha hai, and therefore the cost push inflation, the inflation caused because of excessive demand exceeding supply in pure economic parlance, has created this huge amount of inflationary uh, risk on global markets, which might continue. And therefore, I think that is one huge element in terms of liquidity being pulled out, because if easy liquidity is there, it will fuel inflation even more. And that's why the central bankers are pulling back on liquidities, hiking rates. You start pulling back in terms of your demand, because left right demand jo aa rahi thi at uh, interest rates which are zero or almost sub zero in some cases. I think that will put a stop to that, and ultimately demand can get clawed back a certain bit, which can pull back inflation. So I think the whole intention of of the government in terms of private capex is to balance this out, which also brings me to the next question which Anubhav had put forth, right? Which I just wanted to put forth as my comments as well. I think this is the scenario that is getting played out right now, right? Eurozone as a region, the inflation stat stood at 5% for the region as a whole, right? A couple of weeks back, 3 weeks back. In a matter of 3 weeks, that has moved up 15 bits. So it is 5.15 at this point of time, because of all these factors that I spoke about at this point, right? Uh, how is the Fed going to conquer this? And therefore, I've got a very, very interesting take on the Fed, what Anubhav was mentioning, right? The markets were in a jittery fashion on what the Fed will do. Clawing back of liquidity. What Powell said again was that we thought this was transitory. It never is transitory, but in fact, it's turning out to be much worse for all these factors, obviously, that we know about at this point of time. And therefore, I think when you're talking about inflationary trends in the US, the job roles are not that great at this point of time. There are two scenarios which can now play out. One, I think the Fed goes on an aggressive interest rate hike, which basically means that in March they hike 50 bips. And what the expectation is that on every policy meet, that is every bi-monthly meet that they probably meet, they might announce a 25 bips hike as well. In my tweet and one of the global reports that we carried, I actually put forth exactly a week ago, both the scenarios in terms of rate hikes that have happened over the last 3 decades in the US and the interest rate hikes in the Indian context over the last 2 decades as well, right? India, obviously, I think we are playing safe, as I said, because of imported inflation. All these factors start playing in. Maybe RBI might need to do hikes in the near future, but they'll give us a sufficient amount of time. But my own sense is that looking at the borrowing mix, looking at the borrowing program, a reverse repo might actually come through first. And what you're talking about in terms of repo hikes or the rate hikes, depending obviously in terms of how worse the global situation gets, my sense is that I'm still comfortable in terms of the entire year, the remaining 8 months of this calendar year, of not more than 50 bips that RBI will do. The second element is, if Fed continues with these rate hikes, right, it obviously claws back demand, it claws back liquidity into the system, employment numbers are not great. So does that create a vicious cycle where you had tremendous amount of demand actually plateauing and actually slipping off the cliff as well, which basically means that you're actually looking at GDP numbers, because this entire cycle, as I said, manufacturing, consumption, and then discretionary spending is all intertwined. Now, if that comes off, right, the tremendous growth that you probably saw, obviously based in terms of liquidity support that the Fed had given, in terms of benefits that the federal government had given during COVID times, the checks which used to come to the households, a general US household, all that disappears. Jobs are then becoming scanty if it falls off the cliff. Because as economies claw back, corporates will also claw back in terms of spending. And it's an exactly opposite cycle of the capex cycle that you're talking about, where they start clawing back in terms of fresh investments. And therefore, the entire vicious cycle on the downside that starts playing out. The other scenario that I'm looking at on a positive aspect and a very pragmatic and practical aspect is that Fed might not carry out, and this is my view, I might be wrong, but this is my interpretation in terms of what might happen, which we'll come to know in the next few months on what actual action the Fed takes. That they might take an aggressive hike first time around, but they will go a little bit slow, looking at data points and not allowing the economy to go up the cliff. So they will ensure that the hikes happen so that the liquidity is clawed back. but not in a fashion where demand goes off in a cliff, corporates start clawing back in terms of fresh investments, employment numbers start coming off, and therefore the entire purpose gets defeated with rate hikes, and the economy starts going into a negative terrain as far as reported numbers are concerned. So again, the whole reading is that maybe a reasonable hike in March, but calibrated hikes, looking at data points, which should soothe the nerves of the market. Second, and not the least, second element that also needs to be observed, Anubhav, is earnings, right? And ultimately, I think the markets are going to react to earnings. And look at the reactions that the market is giving. Facebook, I think in post-closing trade, right? The metaverse that you're talking about, there's a lot of memes and jokes moving around. Is actually locked down, right? I think is that's what the presumption is, 15 or 20%, if I'm not mistaken, because of a poor number and a very poor update that he's probably given in terms of outlook. So I think that is how the market reactions are and might be in terms of earnings, because in a strong liquidity phase, even through the COVID crisis, because liquidity supported markets, a lot of fiscal stimuluses across sectors. I think the entire purpose was to ensure that support happens budgetary and off budgetary as well for a lot of corporates. So therefore, I think my sense, again, as I'm saying, is that there will be calibrated hikes even after a strong rate hike, and the markets would probably able to gestate that. Where does that leave the markets? I think it leaves the markets in terms of two or three factors. One, as I said, global macro points in the Indian context on how global indicators are, whether that imported inflation comes through in terms of conservative numbers being put forth. If that probably happens and it plays out in terms of what the government is looking at, we might have a lower number as the IMF and rating agencies put, and cut GDP forecast and a lot of nation GDP forecasts as well, including US, including China, including the Eurozone, and including India as well. Second element is earnings. The earnings have remained exceedingly and resiliently strong. Now, in the Indian context, the corporate debt to GDP, right, in terms of the 2004 and 8 cycle, which was the last bull cycle that we saw, even at that point, it was 1.5 to 1.6 odd times. It is around 0.4, 0.5. Case in point, steel companies strongly deleveraged in COVID years, which was improbable and impossible, right, at the start of COVID. A lot of steel companies are talking about being debt free. Graphite electrode companies, even before the COVID crisis, already had become debt free. And therefore, this exhibition in terms of stronger corporate balance sheets are very, very evident. Second, a lot of positive data was put forth by the chief economic advisor. So he put forth a lot of positive data in terms of GDP forecasts, in terms of our export initiatives, in terms of the foreign reserves that we've got, the real GDP growth, and inflation being under control. Inflation in the Indian context will stay largely in that price band of 4 to 6%. We are a little bit on the higher side of the tolerance band, but food inflation should remain in control. And as fuel starts coming down, it has spiked up because of these geopolitical issues, Ukraine, Russia, China, Taiwan, some drone attacks that we are seeing on the Middle East. But it should start stabilizing and coming down, which means that the inflationary aspects from crude, on crude derivatives for a lot of companies, and the second round of effects of inflation on logistic cost, higher logistic cost, transport, travel, all that starts coming down. So I think the fuel inflation, if it stays under control, and if you are cognizant to the fact of imported inflation being set at a set parameter, looking at our foreign policies and the reserves that we've got, almost 13 months of import cover, that should provide reasonable amount of stability. On the sectors and stocks, we've obviously covered that. Rushit covered that very, very beautifully on positive impact on certain sectors. I put it on my chat as well on certain sectors and stocks that were probably asked for, and certain stocks that should benefit as well. So I think that was my take in terms of the entire perspective that has sector and stock implications as well. Suman has a question, some idea on impact on subsector, industry, or stocks? You already covered that, Suman. I just mentioned that. Impact of startups, you see the chief economic advisor slide, and he beautifully represented that, if you guys can recollect, right? He's represented, I think, I don't remember the base year, but at 2021, startups mushrooming all around the country. Mumbai, Ahmedabad, some regions of Uttar Pradesh is what he said, Lucknow, Bangalore. So what the take is that startup culture is mushrooming in India. We've got one of the youngest populations in India. Digitalization is expanding leaps and bound into the economy. Corporate balance sheets are far, far leaner, and we're in a far better state at this point of time. Our fiscal deficits, current account deficits are in control compared to a lot of countries, including the developed world at this point of time. Our median working age is one of the youngest in the entire world across at this point of time. We've got stable government policies which are expected to come through. We are expecting to see a lot more happening in terms of BFS. I mentioned that in detail in one of in the chat room itself at this point of time, and very very comfortable balance sheets because of RBI, the regulatory provisions that we've got. And you see what the chief economic advisor also said, right? The scheduled commercial bank, SCBs as they call that, the gross borrow NPAs and net NPAs have come up significantly, and their balance sheets have got strengthened. Corporate balance sheets are also looking in fine fettle with a lot of schemes coming in. The PLIs are actually going to work. I gave you the example of the ROS CCP scheme for electronics, which worked wonders. All these PLI schemes for autos, textiles, garmenting, solar panels will yield dividends and benefits significantly. So I think to answer the second part of your question, Anubhav, on how the markets are poised, maybe we are slave in terms of how global markets can behave in the near term. Over the longer term, right? This is India's decade, and India is going to do exceedingly well over the next 5-10 years, because this is the time that India is going to ride based on all these factors putting in its favor, and strongly and squarely is what I believe the next 10 years belong to India. So with this, I think I'll call it perhaps. Thank you very much for attending this. It was a fabulous effort again from the entire team, Rushit, Rajshekhar, Vakar, Yash, Yatisha, Pavan. A lot of efforts have gone in both the pre-budget and post-budget report. And therefore, I think the entire perspective in terms of the implications is something that you can read on the app and the site as well. Suman, I'll take your last question about AMCs and insurance. As a country, financialization of savings is still very, very minuscule. We have hardly scratched the surface. You still go to the hinterland. I speak to a lot of people out of the hinterland as well, where they've got a lot of financial assets with them, but they're very, very scared to invest in equity assets because they don't feel or cannot hold these assets like they can hold or see land or other belongings or even gold to a certain extent. But the thinking is changing as more and more people come into the financialization part in terms of the structured investment and the positive aspects of that. I think the longer term trajectory obviously looks very, very good for AMCs. For insurance companies, the penetration, as the chief economic advisor said, is only at 4.2%. So you can understand what I'm looking at and what India is probably looking at in terms of even say 4% more of the population getting insured over the next few years. Look at the scope that it lays out for a lot of these insurance companies. So I think I'm drawing out a larger canvas, Suman, but the point here is that penetration is very, very low in both these aspects, and both these aspects should see continuing greater traction, enthusiasm from Indians, because as discretionary incomes move higher, and as I mentioned last time around as well, our per capita income has just touched the $2,000 mark. As this moves higher and higher, I think the need to financially secure oneself, the families, also will take precedence over just food, clothing, and shelter. With this, I'll call it a wrap. Thank you very much for attending. You be safe, and let's hope that we have a great year ahead. Thank you, guys.